What is going on, investors? Hopefully you guys are doing well out there. That is right. It is time for the FAANG Stock Recap Show here on the Investor Channel, where every Friday we recap all the major news of the week and the technical patterns from all the major FAANG stocks. And boy, it was an eventful week, so we're not going to waste a lot of time. We're going to kick things off like we always do with Facebook. But the first thing that I do want to point out before we get into this important week where we saw earnings from numerous of these companies, and we've gotten earnings from all the major FAANG stocks outside of NVIDIA, which reports this upcoming month, I want to talk about something that we have not dealt with as investors for a very, very long time, and that is inflation. In my most recent newsletter, which I send out for free to anybody that subscribes, those links are in the description below, I sent out and I wanted to remind investors that in Q1, which is the quarter we're comparing our revenues against, in the most recent quarter for all these FAANG stocks, January's inflation was 7.5%. February's inflation was 7.9%. March's inflation was 8.5%. That average of those three was 7.9%. So that means even if you've gotten a 7.9% raise year over year, you're technically not making any more money, or your money has the same purchasing power despite that 7.9% raise because of inflation. You have to do the same mathematics when we're talking about revenue growth. Facebook grew 6.6%. That means it's down year over year based on inflation. Apple grew at 8.6% year over year. They're just barely beating inflation. Amazon grew 7.3%. You wonder why that stock is down? Because their sales aren't outpacing inflation. Netflix grew 9.9%, just slightly beating it. Google grew 23%, very nice. Microsoft grew 18.5%, very nice as well. And Tesla bringing up the rear, but doing the best job in terms of fighting the inflationary times we're on. Their revenue was up 65%. I bet you can look at this chart right now and compare it to the inflation read, and you'd be able to pick out which three stocks I would be actively buying and which ones I'd probably take a little bit of a break on. We'll talk about more of that as we move into the show. Kick things off with Facebook. Started the week at $184 per share, and it popped all the way to the upside after reporting those earnings. I am completely out of Facebook. This is just for transparency purposes. You don't have to follow along with my trades. In fact, I wouldn't recommend it. Although I have a pretty long track record of success in investing, I am completely out of Facebook. A lot of it has to do with the fact they grew their revenue 6.6%. Inflation was 7.9%. That's not really good math. Now, those earnings came in. They were pretty good. I personally think the street was expecting this stock to completely fall off a cliff and fall flat on its face. It's just simply not the case with Facebook. But here was like the killer quote that once I read this, I was already highly likely to sell at least the vast majority of my Facebook stake, which I think was about 25 shares that I had left over. I was maybe going to keep 5, but then I read this quote from Mark Zuckerberg on the most recent earnings call, and I quote from Mark Zuckerberg. He said, based on the strong revenue growth that we saw in 2021, we kicked off a number of multi-year projects to accelerate some of our longer-term investments, especially in our AI infrastructure, business platform, and Reality Labs. And I don't think any investors had any problems with that. And then he went on to say these investments are gonna be important for our success and growth over time. I agree with that. So I continue to believe that we should see them through. But here's the key sentence of the entire conference call. But with our current business growth levels, we are now planning to slow the pace of some of our investments. So basically what Mark Zuckerberg said is our business isn't growing very fast anymore, and so we're going to actually slow investment. I'll tell you what, guys, if somebody knocked on your door and they say that I have a business that was doing really well in 2021, business is starting to slow a little bit, and I'm not able to invest for the future. And then they say, will you invest in my business? You would probably slam the door in that person's face and say, no, thank you. I am not going to invest in your business, since your business is starting to slow down and you're cutting the pace of your investment, which I think in an inflationary environment, this is when you need to go out there and be aggressive and gobble market share while your competitors writhe under the forces of inflation. Well, Facebook doesn't appear to be doing that. In my opinion, that is a mistake, and that is why I will be on the sidelines with Facebook for the time being. Now, Match Group gained earlier in the week as speculation that it could be a potential target for Facebook. If maybe some of you don't know, Match Group is a publicly traded company under the ticker symbol MTCH. Company obviously owns Match.com, which, look, I'm a married man. I don't know if these things are popular anymore, but they obviously own Tinder as well, which I do believe having some single friends is still relatively popular. Match Group is worth $22 billion on the open market, so that'd be quite an acquisition if Facebook decides to do something like that. Now, this would normally be the lead story if we didn't have earnings for most of these companies, but the EU goes after big tech with a digital service acts. They are going to force these companies like Twitter, like Facebook, like Google to tell regulators exactly what they are doing to combat misinformation online and quickly rid their platforms of illegal content such as terroristic stuff and other types of abuses. I think on a lot of that stuff we can agree. There's probably going to be some gray area, what is misinformation and what is not, and that certainly will create some conflicts for these sites in the future. We'll see how they're able to handle this, but there are quite stiff penalties for the companies not complying with this law, which is expected to go into effect as early as 2024. Fines could potentially be up to 6% of the company's global annual revenue, not profits, global annual revenue. 6% of some of these companies' revenue, especially when you're looking at all these companies, okay, but especially something like Google. I mean, we're talking about tens and tens of billions of dollars, hundreds of billions of dollars maybe, and that would be a problem. Well, Meta Platforms is opening its first retail store to offer a hands-on hardware shopping event. This store is actually opening up in their company campus in Burlingame, California. But what it started to make me think is broadly, okay, if this is Facebook's strategy that they're going to roll out the Oculus, they're going to roll out all these different kind of hardware devices, well, now they're going to have to roll out to retail. And obviously, if you look at like an Apple, and maybe there's some other examples, certainly a Nike as well, there's some really good examples of retail stores that do really well. Maybe even like a Louis Vuitton or something like that, where you always see lines out the door. So if Facebook's got to go this route, how difficult will that be? How capital intensive will it be to open up a bunch of new stores? Or will they partner with like a Best Buy or maybe some existing store out there? It'll be interesting to see Meta's strategy going forward. Moving on to Apple, started the week at $159, basically flat after reporting their earnings as well. Those came in at $97.3 billion. That was 8.6% year over year. But again, you have to factor in inflation, guys, because the inflation read is year over year. And I showed you the average on a quarterly basis. It's basically 8%. So these companies really have to beat far greater than 8% to really have any revenue growth there, especially companies like Apple, where they're really consuming a lot of the inflation out there in terms of the transit costs to get their goods to and fro. Also, the employee costs that we're seeing, all the raw material costs as well that goes into their products, into their phones. Yeah, Apple is kind of really experiencing a lot of that inflation, and to maybe not be able to pass that down to the customer like we saw Tesla do very successfully on their earnings. Well, it is a problem, quite frankly, and this is why the stock didn't move. I think people thought I was going to get on my earnings call videos, which I'll have links down in the description below, and probably the first pinned comments if you want to catch up on all the earnings videos. I'm kind of brushing over the earnings for most of these companies, obviously if you want to review that, but I had comments saying, why am I not falling in love with Apple? Well, guys, inflation was 8% and their revenue growth was 8%. It's a disaster. Okay. Apple raised its dividend by 5%. Again, that's nothing I was very excited about, considering, again, inflation year over year is 8%. So I'm basically getting I'm paying a negative 3% on that dividend. It's not great. Okay. They did boost the buyback by $90 billion. That is going to keep support under Apple stock. And so I'm not, even though I'm bearish on some of these companies like a Facebook, certainly like an Apple, and by bearish, I mean, I would say probably over the next 2 quarters, we can bring up earnings estimates of some of these companies, but I'm not super bullish about a lot of the price action. And here it is in terms of the estimates with Apple. Look at the upcoming quarters. We're actually projecting negative earnings growth in the upcoming quarter, and the following 3 quarters are under 9%, with another quarter being negative in terms of that earnings growth. When you stretch out the estimates for revenue growth over at Apple, there's just 1 quarter CAGR over the next 2 years where analysts thinks you get to double-digit growth. And so if we have 6, 7, 8, 9% inflation, guys, you're not keeping up with it in a stock like Apple. So yeah, I'm going to be am I going to sell my Apple stock? No, this is not something I would sell. I'm going to collect those dividends and those rising dividends. I'm going to know that Apple's going to be right behind this stock with a $90 billion buyback. Would I short Apple stock? No, you'd have to be absolutely nuts to short this stock. But this stock, in my opinion, when we go over to the technical segment of the show, has little hope of going back to the highs. Now, speaking of little hope of going back to the highs, that's going to be Amazon for a while. And it's for the exact same reason. This week, the stock started at $2,880 per share and hit a new 52-week low close to 2,475 shares. In the after hours, Amazon posted their net loss of $3.3 billion. That was the one thing that I really hated about Amazon's earnings. I'll show that to you in a second. Revenues grew just 7.3%. It's showing you that they're not able to increase their sales despite 8% inflation year over year. They're not able to pass those costs down. Maybe it's due to the competition you got with Walmart and Target. They just simply got to eat the cost over at Amazon, or maybe their just business isn't very good in an inflationary environment. It's just is what it is. But what is probably even more despicable about Amazon is you had operating income absolutely disintegrate over the last 3 months. Look at this. You went from $8.8 billion in positive operating income all the way down to 3.7. I'll remind you, this company has a $1.2 trillion valuation, and they just had a quarter where they printed $3.6 billion to the operating income side, let alone you flow all the way down to net income, and you have to recognize that disastrous Rivian investment. Well, this company is going to go nowhere fast over at Amazon. Those estimates are going to come in, and in an inflationary environment, Amazon is not keeping up. Now, did I sell my Amazon shares? Absolutely not. I'm into this one under $1,000 per share. It'd have to come a way back for me to even think about selling my shares. I saw a lot of people saying this is $1,000 stock. Well, then you'd have to more than cut in half this market cap. At some point, somebody would just step in and buy this company. You get south of a couple $100 billion market cap on this one. This is a company with $116 billion worth of sales. So for a full year, you're looking well north of $400 or $500 billion in sales on this company. And a lot of those profits are tied to a very, very high margin business in that AWS business. This company is not in any trouble, but over the next 6 to 12 months, do I think Amazon stock is going to go back to the highs? Absolutely not. There's nothing in these financials that would tell you that is even possible anytime soon. Moving on to NVIDIA, started the week at 194. This company did not report their earnings, but we did see Intel come in. That impacted the stock a little bit. You see during the day, stock was down over 6%. Again, on the heels a little bit, I think, of that Intel number coming in. Ended the week on NVIDIA closer to 186. Now, Intel, Advanced Micro Devices, which is AMD, may have PC weakness already baked in. That's according to BOA. Obviously, the more these stocks continue to go down, the more bad news that they have baked in. So it actually should get you excited as an investor. And if you got some cash sitting on the sidelines, which I've really been preaching, not necessarily on every video, but on a lot of the videos where I've talked about kind of more macro strategy, it's, hey, have cash on the sidelines. As these stocks start to pull back, that's when your opportunity comes. Just understand, this is not 2020. They're not going to pump $3 or $4 or $5 trillion into the system anytime soon. And so these things aren't going to bounce back right away. Now, in terms of NVIDIA, I do like the setup in terms of their earnings estimates. I'm seeing like mid-20s growth slowing to kind of like high teens growth over the next couple quarters on the earnings side. And they're set to make 20, 30, 40% in some cases in terms of their revenue growth over the next couple quarters to kind of slow down to the mid-teens. We'll see if NVIDIA is able to keep that up. Again, with inflation where it's at, you really have to be at least mid-teens on your earnings growth and your revenue growth to be even close to keeping up with inflation. It looks like NVIDIA is doing that as it pulls back. That is a stock, I think, that looks rather interesting, just not right this second. Now, moving on to Netflix, start of the week at $214. This one continues to drift lower. It's down to about $191 per share. Hulu grabs its hit, I can't really say that word, but The Creek Show from Netflix. I'd have to change all these settings in YouTube, so I'm not going to say something that sounds like a four-letter word. But the interesting thing is this has been a hit series over on Netflix and has been a reliable top 10 streamer over the past couple of years. Well, now it's going to Hulu. And so whether or not this is a great strategy by Netflix to really build up popularity in a series and then have it move on to another streaming platform, obviously a sign of the competition that's out there, and certainly something you have to think about if you're an investor in Netflix. Moving on to Google. Start of the week at $2,407 per share. This one also slipped underneath a key technical level, ended the week closer to $2,288 per share after coming in with earnings that weren't bad. Okay, Google's earnings weren't bad. It was just like on the edge of this is why we always talk about the fundamentals and the technicals. I felt with Google, they were on like a technical edge from a price perspective, and it's simple. These earnings just simply kind of pushed it over. People were kind of expecting a little bit more, but this is a stock, if they can continue to grow in kind of this mid 20% range, well, that is certainly keeping up with inflation's. Revenues grew to $68 billion, up 23%. They had a little bit of a slowdown here on YouTube. I've noticed that too. I've noticed that my views have gone up, but I'm not making any more money. And obviously being an online advertiser as well, I spend a lot of money on ads, and I am just walking every month, I feel like I can just keep walking my bids back and back and back. The demand for online advertising in an inflationary environment, and then on top of that, we had negative GDP read as well. That combination, inflation and low growth, I think that's called stagflation. That's a bad combination for online advertising. But again, you come out on the other side of that, and it can be incredibly bullish for a company like Alphabet. So we're not going to sell our shares in Google. We'll likely add to them over the next 6 months. But just because I say I'm buying Google, I have no expectations of this stock being $3,000 anytime this year. I think it's over. I think the top might be in on most of these stocks, quite frankly, based on what we're seeing. Obviously, the macro environment can change. We'll certainly keep you abreast of that as that situation develops. Now, Alphabet's earnings calls addressed that YouTube slowdown that I talked about, investing aggressively. This is what I like about Google. This is why I would take my money out of Facebook and, quite frankly, move it into Google, because they're investing aggressively. Where I showed you the Mark Zuckerberg, they're actually pulling back on their investing. In an inflationary environment, you want to aggressively invest. Now, whether or not you agree with what Google is investing in, a lot of shorts, a lot of material, look, I think it's good. I think it'll pay off down the road, but just understand these investments are going to take a while to pay off. In terms of those estimates and kind of that down the road that we're talking about with Google, here's our earnings estimates for the next couple quarters. They're all south of 4%. We get a nice spike in Q1 at 23%, but then it goes back to kind of mid-teens growth. The next 3 quarters, again, this is not according to me. According to analysts, we're going to have negative 1.3% growth in the upcoming quarter. Then it's going to go to 3%, which I guarantee you is not going to outpace inflation. Then you're going to go to 4.5%. None of that is going to outpace inflation. That, to me, is why you saw some pressure on the stock. Same thing with the growth rate, really over the next 2 years with Google. Analysts aren't projecting this company to grow. We just talked about how they grew their revenues by over 20%. Analysts aren't projecting a growth rate over 15 for the next 2 years with Google. So you have to factor that in when we look into these companies. They had a huge acceleration in demand in their business due to COVID and the stimulus checks and all of those things. Those days are over. So you have to factor that in if you are an investor in any of these companies. Moving on to Microsoft, started at $273. I did buy this one. I literally bought it, and this is not advice. This is actually a really stupid thing to do, and I wrestled with it all day, but it wasn't until right at the end of the day, right on the 26th, right before earnings, I did buy this one for $270. It popped up nicely. Regardless, whether it went up or down, it wasn't the best decision, even though it worked out, at least in the shorter term from a monetary perspective. But the reason why I did that is I really thought deeply about Microsoft's business, and I said they have a ton of recurring revenue. They passed some price hikes down on Office 365. We probably saw just kind of the initial wave of those in the most recent quarter. And I think we're seeing this company in particular outside of Tesla. I would say Tesla's number one. I'll get to that in a minute. But I think in the environment we're in, high inflation, low growth, Microsoft will do a little bit better than, quite frankly, probably the rest of these companies outside of Tesla's. Revenues came in at $49.4 billion. That was 18.5% year-over-year growth on that Microsoft side. Activision Blizzard shareholders approved Microsoft's acquisition with you think this is right? 98% in favor? Yeah, based on where the stock market has gone since this deal was announced, Activision Blizzard shareholders are getting a pretty sweet deal. Now, in terms of the upcoming profit growth with Microsoft, paints a similar story to the rest of these stocks. Kind of low to mid-teens growth on that earnings side, and really just kind of mid to low teens on that revenue side. And again, depending on where you think inflation will go. There's so many arguments out there. I can't predict. I don't know where inflation's going to be in 3 months, 6 months, or 9 months. But I tell you what, if it stays on the trend it is right now and stays north of 5, 6, 7%, maybe even potentially goes higher, yeah, these revenue estimates are not nearly good enough, quite frankly, okay? That is why, if you ask me today, what is the one stock that I'm confident will do well in this inflationary environment and slow growth environment? Well, it's probably Tesla, okay? Because when we looked at this company's earnings, they were such a blowout on that earnings side, on that revenue side. They are projecting that for the rest of the year. They've got a backlog of their business that goes basically out over a year. They've got products like the Cybertruck that if they could deliver today would sell out like crazy. This is a fantastically run company, and, well, its CEO is capable of handling a lot of things. And he bought Twitter this week, or he agreed to buy Twitter. Don't think that Elon Musk has control of it now. This deal will likely take several months to get wrapped up. Hopefully it does. But he agrees a $44 billion deal that will make Musk one of the primary shareholders. I think he's putting up a portion of his money. And we saw that this week, Tesla stock just kept going down, and I actually bought it multiple times. I'll show you when you get over to the technical segment of the show. I'll show you the areas that I bought Tesla. I bought it like 3 or 4 times this week. Again, if you are a subscriber to my newsletter, I actually tell you the stocks that I bought and kind of my successes and I missed for the last couple of weeks. And I told you the areas that I bought Tesla over the last few weeks. And Elon Musk did sell this week. I took that actually as a buying opportunity. He has to sell so he can buy Twitter. In the long run, I think the Tesla is the equity that you want to own. Now, Tesla slid with India pushing back on its plan to sell imported vehicles, making in China, when they're referring to Teslas, and selling here in terms of India is not a good proposition, somebody in India said. And look, I respect India for that, okay? Guess where Tesla is going to have to open up a manufacturing facility? They're going to have to open it up in India. I respect India for making manufacturers, certainly ones with multi-billions of dollars and the ability to build those manufacturing plants in India. I would guess over the next 4 to 5 years, you'll see Tesla building a manufacturing facility in India because that's what they're going to have to do to sell cars there. Now, moving on to the technical segment of the show, we'll kick things off with Facebook, and they basically had what I think is going to amount to kind of a dead count bounce on the shares from a technical perspective. We are now, I believe, still in this kind of downward draft. I'm going to change the color of these red lines so they stand out a little bit more. I'll change them to kind of a darker green color. So now I believe we're in this downward channel with Facebook, okay? We had that initial drop after last earnings, not the most recent ones, but the ones before that. Stock dropped down to 240. I told you I'm out at 220. I got out. I got back in, rode it up, watched this thing drop back down, came back, sold out the remaining shares I've had. I did well on my initial stake with Facebook. I think I had like $140 cost base on this one. So when I initially sold that at 220, it was actually a pretty good sale for me. But Facebook is now reacting exactly how you'd expect a stock in a channel, a downward channel, to do. It has worked its way back up. It's about in the middle of the channel right here at about $200 per share. There's overhead resistance at 219, which consequently is the top of the channel. I don't expect Facebook to get back to that point, but if it does, it will likely get rejected and come right back down and likely make a lower series of lows. We have a lower series of lows back in March at 189. We have another lower set kind of in the tail end of April at 180. I think in a couple of months, this stock will be back down here south of $170 per share. There's not a lot of tailwinds behind this company's business. When you look at Google's revenue estimates, which I showed you, when you look at Mark Zuckerberg saying that their business really isn't quite going so well. Another thing that I want to show you with Facebook is I pulled this up on my Facebook video, so some of you have seen this before, but ever since the initial iOS changes that don't allow Facebook to show the type of targeted ads that they need to show in order to make lots of money, those changes went into place Q2 of 2021. Okay, online advertisers started to make their changes really until the next quarter. A bunch of them just said, screw it, it's now the fourth quarter, we're just going to let our ads roll. And now here we are again in Q1 of 2022. This was the most recent earnings. Facebook was expected to do $28 billion worth of online ads. They did 27.9. The upcoming quarter, again, expecting 28 to 30. They were expected to go over 30. Facebook cannot get over $30 billion worth of revenue in a non-fourth quarter. That is going to just keep this stock in a downward trend, quite frankly. That's what I think. At the very least, you're not going to be able to push back to the highs with this stock. I don't see anything that this company could do to push it back to the highs in the shorter term. Now, I'm not saying for the long term. I'm saying just for the shorter term. And when I say shorter term, it's probably a quarter or two until we start to get some visibility down the road. Right now, not a stock I'm interested in. Moving on to Apple, it's basically making the move we thought it would. It's pulling back. We have this downward red trend line. It's pulling back. It's trying not to get back into this downward channel with Apple. We talked about if we pull back into this downward channel, this bottom line down here will act as kind of like a magnet or gravity, and it'll continue to pull us back down. As Apple pulls into this downward channel, these can be buying opportunities, depend on where you stand with this type of business. There's an area of support down here with Apple at 138. Now, obviously, this thing could reverse. Sure, it wouldn't surprise me. You had such an ugly day on Wall Street today. You could have a bounce back, but again, you'd have to get above the previous sets of highs, which are all the way up here, $20 higher, over 177, near the all-time highs over at Apple, to really kind of break out of this downward channel that we're in with Apple. And it's kind of a downward sideways pattern, as you'd expect a company with a $90 billion buyback and certainly plenty of revenue and earnings and cash flows to not completely fall on its face from a stock perspective, but this is not one I would expect to snap back and go higher. Longer term, we actually love these companies. These are the areas you accumulate. I probably should stress that as I'm moving through this. As I'm talking negatively about these companies' upcoming quarters from an earnings perspective, the guidance, the revenues, the stocks pulling back, that is actually a positive, because longer term, these companies will come out on this difficult environment that we're in and actually be far better for it in the longer term. Now, Amazon broke a key area of support. We had a support here for the longest time at 2,700. It was previously up here closer to 3,000. It kind of broke through that and touched it. That was probably the first sign of distress for the shares. Now it's completely in a downtrend. And quite frankly, the bottom end of the support is down here at about $2,000 per share with Amazon. You get down there, and then from a valuation perspective, it certainly makes a lot of sense. We'll see if Amazon can pull all the way back down there. That would actually be exciting. And again, the reason why I'm talking about the downside with this company is what is going to shoot Amazon back, at least back up into the upper channels where we were over 3,200. Like, what is really going to drive this stock up over that if they can't even grow their revenues and their profits more than inflation over the last year? It's just not going to happen, quite frankly. Now, moving on to NVIDIA. Again, they did not report their earnings this week, but this is pulling back, essentially hugging this kind of downward channel that we've been in for many, many months with this stock. We still contend that this stock has a high probability, in my opinion, of pulling into this box. You pull into this box with NVIDIA south of about $160 per share. Valuation starts making a lot more sense, and from a technical perspective, could actually find a bottom in that range. Moving on to Netflix. Boy, when you got to zoom the chart out this much, it's not good. This stock obviously has been on a massive decline. I tried to trade this successfully. I still think that, I mean, I have to move it. Okay. It's never good when you have to move your trend line to fit like your narrative, but I still think this longer term uptrend is still intact. I did have to drop it to, fit my narrative of this blue line still being intact, but technically Netflix is kind of holding in there. Again, we did see revenue growth of 9%, which actually was kind of the stronger end of the FAANG stocks. I think this stock finds some footing, but again, what's the catalyst to shoot it back into the $300 price target with this one? I think it might be a ways away, quite frankly. Same thing with Google. The earnings were great. We love Google. Google actually helps pay some of my bills, okay? I love Google as a company. I love this stock. I bought this stock a long time ago. I think it was like $700 or $800 when I got into this stock originally. I really want to buy some more of this stock, but from a technical perspective, it was just kind of in this massive downtrend. Its earnings didn't impress enough. It broke through this level at 2,500, and now it's kind of pulled down to lower levels. It's just going to keep dropping. There's areas of support down here at about $2,000 per share. It probably starts at about $2,100 per share. Quite frankly, just another $100 in this stock, and I think you could find some footing. I wouldn't necessarily be aggressive in terms of my buying opportunity because, again, my point with all of these stocks in the shorter term. Longer term, I am still bullish all these stocks. I think most of them have a great shot over the next 5 to 6 years to double their market cap, which is exactly the kind of growth rate you want your stocks to be on when it's these kind of high growth type of names. Okay, do you want your dividend growing stocks? Do you want your kind of safety stuff to grow that rapidly? No, not necessarily. But the Googles, the Amazons, the Apples, certainly the Teslas and the Microsofts, yeah, we're trying to grow maybe 15, 20% a year on that market cap and trying to get to a double very, very quickly. I still think that is possible, but I think you're going to have some time to accumulate these shares at lower prices because I don't know the catalyst that will shoot Google higher when the earnings estimates were really, really low. In fact, they were negative for the upcoming quarter, and we have like kind of low teens growth projected for the upcoming quarters. With inflation where it's at, you're basically just breaking even when it comes to Google. Now, Microsoft set up a little bit differently technically than the rest of you, or I should say the rest of these stocks. That is why I stepped in. The stock was down here at about $270 per share. That was an area of support. So I like this one. Again, you could have made the same argument with Google and you would have been wrong, but I would certainly would not have blamed you. Just understand, Microsoft's in kind of the same technical pattern as the rest of these stocks. It's basically in a downward channel, but I think what will materialize with the stronger FAANG names, the ones that are not really having the big troubles like maybe like a Facebook or even like an Amazon, is they'll start to go sideways. Just like we saw Google go sideways for a while, just like we saw Amazon go sideways for a while, these stocks can go sideways. I think Microsoft's actually a good candidate for that based on their growth rate, based on their business model that does a lot of rebilling. I think Microsoft is well positioned to one you can kind of park some money into, collect a little bit of a dividend, inch into. There is downside risk with Microsoft if you do break through this 270 level. There's not a lot of support until you get south of 220. That's why I'm not jumping in with both feet with the buys. Now, Tesla is easily the most interesting of all these stocks. It has the highest growth rate. We also saw in the most recent quarter that they were able to pass that price increase down to their customers because the Wall Street was expecting their margins to actually go down, and instead they went to record highs at 30% for the vehicles they make. That is what is showing you that Tesla is doing a fantastic job of being able to pass down cost increase down to their customers. On top of that, they've done a nice job navigating the supply chain because when you looked at Tesla's net income and their operating income, it went up huge in the most recent quarter. Not only year over year, I mean, it's up astronomically year over year, but quarter over quarter, you saw that this company did things. And that is why I stepped in aggressively when this stock broke this green line that we've had in here for a long time. It was the previous highs that this stock made back in January of 2021. Those are the previous highs. It has acted as a level of support. I stepped in actually pretty aggressive with Tesla. I probably bought 30 or 40% of a full investment at this level. Now, that's not to say that's a great area to buy, because if we continue to work lower with this stock, it's starting to wedge out from a price perspective. We're making lower highs, but at the very same time, we're making higher sets of lows. So at some point, this stock is going to come to a pivot and it's going to want to break higher or lower. Based on where the market is going right now, I would actually anticipate this stock breaking lower. If you break lower, you have opportunities to buy this one south of $700 per share. I think investors are going to continue to realize, obviously there's a lot of noise around Tesla stock. There's a lot of strong opinions as well. I am looking at this straight by the numbers. This company has a high growth rate. They have high growth rate on their profits. They have a high growth rate on their profit margins, and they're doing this in a very difficult environment. In the environment we're in right now, the number one stock outside of probably energy stocks, maybe even gold and silver in terms of its safety and stability. But if you're looking for growth, I think the one stock out of this group that's going to deliver that will be Tesla based on their results and forecast that we have going on right now. Let me know down in the comments what you think. Hopefully you guys have a great weekend. It was great joining you today. We'll see you again next week. Good luck with your investments.